welcome to Real Estate Today. I'm your host, Laura Harbison, broker-owner of Realty Executive Southern Nevada Properties. And today I have Matt Hennessy of Benchmark Mortgage here with me to talk about reverse mortgages. Hello, Matt.
Hello. Hi. How are you?
Good.
It's a topic we've come across quite often, right?
Yes.
I would imagine that everybody probably listening to this has a similar concern. That is, do I have enough saved to live comfortably through retirement? Mm-hmm. And some statistics that we came across here in the last couple of months were that there's $32 trillion worth of equity tied up in our homes. I think the average homeowner across the nation is somewhere like $190,000 of equity. Now, when you think about that, you're actually equity or house rich, but cash poor. So do you have conversations with your clients often of, hey, should I pay it off in full or take a little mortgage? What do you usually see?
All the time, because I do specialize in the age-restricted communities. A lot of talk about that. There's a lot of stigma kind of surrounding the reverse mortgages, but they do seem like a really good financial tool. Not only can you take equity out using them, but you can do a purchase with them as well, correct?
Absolutely, yep.
How old do I need to be to do that?
62 years old.
Okay.
So, I mean, when we always talk about mortgages, we always think about selecting the right mortgage program to, really maintain our goals. And it's the short and long financial goals that we have for ourselves. So when we think about a reverse mortgage and a forward mortgage, we normally don't say the word forward. So let me kind of explain the differences. So what we're probably traditionally used to is a forward mortgage is, let's say I took out a mortgage for $200,000. And let's just make up a number and say my monthly payment is, let's say, $1,000. So every month when I make my payment, theoretically, instead of owing $200,000, it goes to $199, $198. And over time, I pay that principal balance down. So that's great, except for the times where my clients, like yours, wish to put all their money into a property and quickly pay it off, yet maybe in my retirement, I don't have a whole lot of income to live off of. And perhaps, God forbid there's an emergency, health reasons, or something comes up. It's very illiquid. It's hard for me to get that money out, right? Mm-hmm. You have to go to folks like myself and say, hey, man, I want to go through the steps and the process to obtain a, cash out refinance. And sometimes that's not the most advisable because let's just face it, in my, my last couple of years, last chapters of my life, I'd like to have, retirement income, fixed income, and I might not be able to qualify for a cash out refinance.
Right, because your mortgage qualification is based on your income in that case.
Very true.
Okay, so what are the rules for a reverse mortgage then?
Sure. I'll give you maybe a perfect example is, sometimes someone wants to say, do you walk the walk? Do you walk the talk? And my mother had a great job out here for 30, 40 years and retired in her 70s and, in her 60s and found that she had a Social Security, she had a very small 401k, but unfortunately, when the time came, it's like, I have this mortgage payment. And all of us siblings got together and said, all right, Mom, how much can you, putting a budget together, how much can you qualify for to live off of, right? Not just housing, to keep a roof over our head, but most importantly is the necessities, a car, food, et cetera. Now, we all got together and said, hey, look, we're not out for my mother's interests. We're not looking for some additional, can't wait for my mother to perhaps pass away and get into her assets. That wasn't it. We always said, let's make sure that she's the most comfortable going forward. So about 12 years ago, we went through the process of a reverse mortgage for her. Now, that was a refinance portion where she basically, they don't look at your credit. They just want to look at it just to make sure, if I have blemishes, that's okay. But I want to make sure that everybody understands perhaps the difference. On a reverse mortgage, there's still a mortgage tied to it. So my mother still had a mortgage, yet every month she was not required to make that mortgage payment. What she was required to do was to make sure that she maintained property taxes, the insurance, the HOA. So she'd see bills in there and have to maintain the property. But most importantly, she had to live there as her primary residence. So going back to my mother's situation, it was an opportunity for my mother to have no mortgage payment, and of course, just maintain very small property taxes and insurance. And back then, say 12 years ago, she had the ability to have a lump sum put in her pocket to live out her remaining, chapters of her life without a mortgage payment. So it was a benefit for all of us. Now, again, the stipulations are you need to be 62 years old. So if I was an individual who wanted a reverse mortgage, I'd have to be 62 years old. If I was married And let's say, I'm just going to make up an example. Let's say I was 75 and my wife was 60. She wasn't 62. She could go on this transaction with me. And the reality is that we have to look at the longevity, the life expectancy for an individual.
So that sounds like a very good tool, but what are the risks?
Sure. The risks that we've heard from clients in the past, and if I was to ask a room and maybe just say, hey, has anybody heard of a reverse mortgage? Some might raise their hand and say, my brother, cousin, neighbor, whatever it is, lost their house to foreclosure. The bank took it back. And the reality is, if we scratch the surface a little bit more, we'd realize that that individual perhaps didn't follow the guidelines. And the guidelines are really laid out in a very succinct way, which is it's a requirement for every individual to go through this process to start with free counseling, where they're going to ask all those questions that we're not asking, but they might have concerns as a consumer. Is it still my house, right? I'm nervous that, God forbid, I make a mistake. Am I going to lose it?
Right.
The number one takeaway that we always try to share with our clients is you have to live in that property. So for example, twice a year, if I have a reverse mortgage, they're going to check on me to make sure I'm still living there. And the key is they want to make sure that it's still my primary residence. So every 6 months, they're going to check on it. And if I'm, maybe I have some medical situations, I'm in a hospital for, say, 12 months, then they're going to say, hey, you're no longer living there as your primary residence. And now we have to either call that note due, which just means that the family has to make decisions that they're no longer living in that property as their primary residence. And what are those decisions, right? We've
what
come
are their
across
options?
those.
Right.
They could sell the property outright, which is completely fine. They have the opportunity to refinance the property. Maybe in the passing of the last individual who's on that loan, they have the ability, maybe if there's a life insurance policy, to pay that off. But at all times, they're going to hold on to that property and have a conversation with the family and say, all right, these individuals, the last owners have either passed away or moved out. What are the options now to get rid of that property or hold on to it?
And I've had clients who are very concerned about, is the property going to be upside down?
Sure.
Or is that going to be a burden on my family?
Yeah, which is a great point. It's a non-recourse type transaction, which means that let's just make up an example. Let's say the loan on that property is $100,000, and maybe it's undervalued, right? Or it's just you're underwater.
It's only worth $80,000.
Yeah, there you go. Then the family, siblings, or whoever's left over is not liable for that deficit. So in the end, that's why there's mortgage insurance involved. So it wipes the debt out. So the family's not struggling at the end, like, oh my gosh, the balance went up over time, and unfortunately, the appreciation didn't catch up with it, and we might have a situation. In this case, they're going to probably just sell it outright.
And be even.
Absolutely.
They wouldn't owe any additional money.
And you and I have come across this, the purchase side of it. Everybody knows about the refinance for a reverse mortgage, but a purchase is quite attractive. And I say purchase by way of, let's give one example. Your traditional client comes to you and says, hey, I just sold a house and I want to pay that house in cash. Sounds very attractive. Here's a $500,000 sales price. I'll put it all down. But there's no liquidity left.
Right.
Yet if it was a reverse purchase, how attractive is this? The individual buys it for $500,000, puts just $300,000 down in this example, and they have $200,000 as savings to now live off of, to live their best lives and the choices they want, or have money saved up for perhaps surprises, medical treatment, et cetera.
Right. Anything that might come up that they hadn't thought about. So, well, that's good. And then I think we covered that in the event that your spouse passes away, the other spouse can continue living in the property.
Correct.
Now, there's two facets to this type of mortgage, right? You have your base amount, but then isn't there a line of credit associated with it?
So if there's any changes that we've seen in the last, say, decade or so, you used to be able to pull a lump sum out, and that actually got folks into trouble. They took money out and spent it all. Because remember, the whole process is you still had to have enough assets or money coming in by small amounts of retirement to take care of utilities, taxes, insurance, maintenance of the property. So when we see that, my question to the consumer is, are we in a ready position to maintain that property, or are we not?
Right. So, and when, if one spouse is remaining, that line of credit gets shut down.
Correct.
But they do not have to move. They still don't have a payment, and they can continue as long as they're living there full time.
And speaking with a professional, they'll walk them through as they're accessing the additional funds and equity. They can get a lump sum, a stream of income to live off of, or there's money set aside that grows tax-free and grows based on a 4% appreciation rate that HUD sets. So there's always a growing balance to draw upon in the event of a type of emergency.
Right, as time goes on. That's wonderful.
Yeah.
All right. Well, if you want any more information about this, you can definitely give us a call. You can call me at my office at 702-777-1234, or you can shoot me an email at laura@lauraharbisonrealestate.com. Matt and I are both happy to answer any questions that you have. If you need any additional help, be sure to tune in to our next episode. We will be talking about the importance of doing a financial checkup regularly, and give you some information on the home title lock and things like that people are always calling us about. So thank you, and we'll see you next time.